The market is going up, but only a few stocks are moving. If this is a rally, why is most of the market still doing nothing? Because this rally is not about participation, it's about selection. Stay till the end. The final framework explains why chasing the wrong stocks here destroys the return. A rising market does not mean money is flowing everywhere. It means capital is entering the system, and capital is always selective. The first mistake investors make is assuming that a market rally is a democratic event. It is not. Rallies are driven by capital allocation, not optimism. To understand which stocks move first, you need to understand how capital behaves under uncertainty. Before we reach that point, observe what is not happening. Risk is not being rewarded broadly. Low quality stocks are not outperforming. Illiquid stocks are not attracting sustained buying. Weak balance sheets are not being forgiven. This tells us something important about the phase we are in. When capital enters during uncertainty, it looks for three things: liquidity, predictability, and exit comfort. This is why the same types of stocks lead again and again. Large liquid companies, sector leaders, business with earnings visibility. Not because they are exciting, but because they are safe to own. This is the part most investors misunderstand. If you miss this distinction, every rally will still feel confusing. Stocks that lag in early rallies are not necessarily bad business. They are simply riskier in uncertain environments. Capital first stabilizes, only later does it expand the risk. This is why broad participation comes late, not early. Most investors assume that if leaders have already moved, opportunity must exist elsewhere. So they rotate into weak stocks too early. This is how capital gets trapped. Early rallies reward quality, not hope. Now, here is the core insight. This single idea explains leadership in every market cycle. Market rallies do not lift stock. Capital chooses leaders. Leadership is a signal, not an accident. If capital keeps returning to the same name, it is telling you where safety still matters. In early and transition rallies, follow leadership, not regards. Respect relative strength. Wait for clarity before increasing the risk. The goal is not to catch everything. The goal is to avoid being early in the wrong place. If you understand why leadership repeats, you stop fighting the market and start aligning with it. That is how consistency is built, not by prediction, but by observation.